Hello and welcome to Bytesize Newscast number 15. In today's episode, we're having a look at Ethereum, more specifically at Ethereum's congestion. Ethereum has basically been suffering at its own success. ERC20 tokens aren't going through, transactions are incredibly delayed, and decentralized finance is very expensive. Now, the Ethereum community has put through Ethereum Improvement Proposal 1559 as a way to help amend this issue. Now, in what follows, I'm going to dive deeper into this proposal. Note that this is going to be a little bit of a technical episode, and I understand that not everyone who listens to this newscast is going to be aware of all the terminology. Now, what I've done to amend this is I've taken all these terminologies, all these concepts, and I've explained them thoroughly in a way that everyone can understand. Now, the aim of this episode is to help you guys understand how Ethereum works, how gas price works, how gas is calculated, and what the proposal means. Now, on top of that, the aim is to provide you guys with a grander scheme of things to conceptualize what this proposal actually means. Now, if you like the content, please subscribe. If you have any questions throughout the episode, please leave a comment or just send me a personal message. Now, also note that what follows is not financial advice, it is strictly educational. So, this is going to be a good one, guys. It's going to be technical, but bear with me. You're going to learn a lot through this episode. So let's jump right in. So, what is Ethereum exactly? What's Bitcoin? What's a blockchain network? Well, a blockchain network is a network of distributed computers. And what does distributed mean? Well, distributed means that they can interact with one another without the use of a central authority. Now, in the case of Bitcoin, Bitcoin is a distributed network of value. And what does that mean? Well, if I send you money, I send it through a bank. That means there's always someone in between our transaction. And what Bitcoin allows us to do is interact with one another without the use of a central authority. So I can send you money through the protocol. And what does that mean? Well, that means that Bitcoin is essentially decentralized gold. It's a decentralized bank. It's decentralized value. It's decentralized money. Now, Ethereum adds another layer to this. The insight that the people at Ethereum had is maybe we can also send a value from one person to another, but we can also add some logic to that. And this logic would be, for example, if I send you to Ethereum, then you won't get that to Ethereum for 2 months. That could be a little bit of logic. Now, when I do this interaction with you, what we've basically done is sign a smart contract. And if you extrapolate on this a little bit, you can figure out where Bitcoin is decentralized value, decentralized banking. If you add a layer of contracts on top of that, you can figure out that Ethereum is essentially a decentralized version of finance, or of trading, of lending, of insurance. Now remember, this is all done without the use of a central authority. So it's users lending to users, users insuring users, and users transferring value to users. Now, without the use of a central authority, how do you get stuff moving from A to B? How do you get value moved from A to B? How do you get smart contracts moved from A to B? Well, a blockchain network needs an incentive method. And how do you incentivize someone to do something? Well, you pay them, right? And who are these people being paid on the blockchain network? They are called the miners. Miners work for the network. And what do they do? Well, they basically add transactions to a block, right? And in this block, with all these transactions, the miners verify these transactions and add this block to other blocks. Now, if you get a bunch of blocks added together, you basically get a blockchain, hence the word blockchain. And why is this blockchain very important? It's because in a chain with these transactions, you can make sure there is no shenanigans. Now, it's very important to know that miners don't have any say on where your transactions go. They simply do the transactions. It's similar to the way when you buy water from the water company, they have no say in what you do with the water. Miners are paid in two ways. The first one being when they add a list of transactions in a block to the network. Now, when they do this successfully, the network itself, be it Ethereum or Bitcoin, actually rewards them with some Bitcoin or Ethereum. And this is called a block reward. The other reward mechanism is through fees. Now, fees are paid by the users themselves. And why fees? Well, basically, if you want your transaction to happen really quickly, you can include a larger fee. Now, this makes this transaction more attractive for a miner to include in their block. Now, if you don't mind waiting a little bit, you can also include a smaller fee. So it allows for some customization as to how fast you want your transaction to happen. So a short recap. Blockchain essentially allows for banking without banks, lending without lenders, insurance without insurance companies. It's just people lending to people and people insuring people. Now, in order to incentivize the protocol to actually include transactions, we put miners to work. Now, in turn, we pay these miners through fees, and the network pays them through block rewards. Now, remember what I told you earlier about Ethereum. Ethereum allows for the use of smart contracts. Now, let's actually go a little bit deeper into that one, and I'll give you guys an example. Now, in this example here, we have Alice and Bob. Now, Alice wants to send Bob 1 Ethereum, but she also wants him to sign a smart contract stating that whenever Bob has less than 10 Ethereum, that Ethereum is sent back to Alice. Now, what happens during this transaction is that a miner is put to work. Now, this miner will sign the smart contract into the network and make sure the transactions happen. But at the same time, the smart contract is continuously being checked. Now, you can already sense that there's a small problem brewing here, because if Bob never goes below 10 Ethereum, the contract is continuously being checked by the miners. And essentially, these miners are stuck in a loop, and they're not being rewarded for it. So you can imagine that if we have enough of these loops going on the Ethereum network would basically grind to a halt. Now, what's the solution to this problem? Now, the guys and girls at Ethereum came up with a pretty ingenious solution to this here problem. And they came up with the concept of gas. Now, gas in essence is what is required to run not only transactions, but a smart contract. And before we jump into the topic of gas, let's do another short recap here. Remember that Ethereum is different from Bitcoin in that it allows for the use of smart contracts. Now, these smart contracts are pretty cool because it allows two or more people to interact with one another without the use of a central authority. Now, the problem with this smart contract kind of method of doing things is that sometimes they are poorly written. And if a smart contract is poorly written, it can actually be stuck in an infinite loop. And if you have too many of these infinite loops, the Ethereum network would simply grind to a halt. Now, the solution to this infinite loop issue is the use of gas. So what is gas? Well, gas is basically what's required to interact with every smart contract. It's also used on transactions. And how do you get gas? Well, you exchange a little bit of your Ethereum, tiny little bit, for it, and you sell it to the protocol, and the protocol gives you a little bit of gas in return. Now, a transaction, the amount of gas required for a transaction is pretty obvious. It doesn't really vary that much. But a smart contract, you might not know how much gas it's going to take to interact with that smart contract in advance. But I'm pretty sure you have a limit to how much gas you want to spend. Now, Ethereum has this kind of built in. So before you interact with a smart contract, there is a certain limit you must propose. This is called a gas limit. Now, this gas limit is pretty handy because it solves two issues. The first one, it solves the infinite loop issue, because if you have a gas limit, there is an amount of gas you're maximum willing to spend. And like I said before, the other issue it solves is that you know in advance how much gas you're going to spend. So you're not spending an infinite amount of money on making this smart contract work for you. Now you may ask yourself, what happens if you've run out of gas? What happens if the gas limit is reached? That's a very good question. Now, let's return to Alice and Bob and figure out what actually happens, right? So Alice puts enough gas in the smart contract to have Bob's wallet checked 20 times. Now, over time, her gas runs out and her gas limit is reached. Contract runs out of gas. Now, in this circumstance, the 1 Ethereum is returned to Alice. That's because the entire contract has been reverted. The entire transaction has been reverted. Now, this underlines how important it is to have smart contracts written properly, because it doesn't take a genius to figure out that you can abuse this mechanic in a not so friendly way. Now, another cool thing about gas is that it allows for price discovery. And let me expand on that a little bit. When the Ethereum network is very, very busy, a lot of people want to use it, right? And when the demand for something is higher, so is the price. And what gas allows to do is it allows this price discovery to happen in real time, right then and there at that moment. And it doesn't really affect the Ethereum price, the price of Ethereum. And the price of Ethereum is based on how many people want to use the network in a long term. So you have this short-term price discovery, gas, and this long-term price discovery through Ethereum. At this stage, you're probably going, damn, that's a lot of information to take in one go. And you're right. But I'm going to bet you anything that when I show you the next little thing that you're going to be very impressed by your own ability to understand what's actually happening. So let me actually drag this into the screen. This is a website, super cool website. I'll put it in the description down below. And this basically demonstrates what happens to the Ethereum blockchain, that's the one on the left, and the Bitcoin blockchain, the one on the right, in real time. Now, I'm going to take you through this one. On the left, we have Ethereum. On the right, we have Bitcoin. Now, as you can see, all these little peoples right here on the left and the right, these are transactions. And these transactions are being added to blocks. These are represented by the vans here. Now, on the left, we have all the biggest smart contracts on Ethereum. For example, Uniswap. And every time there's a transaction on this smart contract, it's added to a block. Now remember what I told you earlier about gas price. When the demand on the network is higher, the price of gas is higher. You pay more for gas, right? And although the network doesn't seem to be that congested right now, there is still something I can show you. You see the way each and every one of these vans has a GUI price. A GUI is the smallest unit of Ethereum, and it's basically the amount of Ethereum you pay for gas. And you see here the first one's 104, then it's 90, then it's 88, and the lower you go down the list, the cheaper it gets. So what this demonstrates is the more desperately you want your transaction to be put through on the network in the next block, for example, the more Ethereum you pay per gas to put your transaction through. Now, before I let you guys go on this one, and I'm going to once again put a link down below, so this is really fun to check out. You can buy your own little items. So just say in case you want to buy the snowman, you buy the snowman and then you put a transaction to, you actually see a little snowman move into the van. I thought it was cool. I wanted to share it with you guys. So that concludes the explanation of what Ethereum is and what gas is and the role gas plays. Now, I wanted to get this all explained thoroughly because even though it's a beautiful and elegant system, it's not without its faults. And Ethereum Improvement Proposal 1559 aims to amend some of these faults. And so in what follows, I want to explain to you guys what exactly Ethereum Proposal 1559 is, the problems it's amending, and what the implications are of this improvement. So what does this improvement proposal actually do? Well, in a sense, it adjusts the way gas is calculated. It's an adjustment to the gas price mechanic. See, as it stands now, people are willing to pay whatever it takes to get their transaction put through as soon as possible. And the problem with this is there's two problems with this. The first one being that you cannot see what price other users are paying, right? So you start with an average price and you're going, well, if I want to put my transaction through as soon as possible, I got to go above the average, right? But you don't know how much because you don't know what other users are paying. Now, at the same time, when everyone's paying more and more and more, it also brings up the average, right? So the average comes up, people are willing to pay more, and the price just keeps going up and up and up and up. Now, this is a massive pain point for the Ethereum community itself. Um, Transactions aren't going through, fees are exorbitant, ERC20 tokens aren't functioning, decentralized finance isn't doing its job, it can't be used because it's too expensive. And at the same time, if you're a new user, then you have no idea as to why sometimes you have to pay X amount for gas and other times X times 4. So this improvement is a very important one. It's very important to sort out this whole gas mechanic as soon as possible. Before we jump into the proposal, I just quickly want to take you guys through this one. And this is actually what the price of gas can look like over time. Now, this is over a longer period of time, but you can clearly see there's some days where the gas price is just ridiculous, right? So there's a lot of volatility even over a longer time span. And even if we look on a relatively short time span, this is a couple of days, you can also see that at sometimes the gas price is like 90 guy, and then other times it'll shoot straight up to 200 to 300. So that's a times 3 in the span of a couple of days. So once again, this is a genuine issue that needs to be resolved as quick as possible. So let's go over a plausible solution. Now this solution is quite simply the lowest fee for gas that's paid within a particular block is what everyone pays. So once again, transactions go into a block and everyone within that block pays a certain amount of fee. Now, in this example here, Alice pays 0.01 Ether for 100 gas, Bob pays double that, Charlie pays a little bit less at 0.09 Ether, and Danielle pays the most out of everyone. Now, in this example, everyone will pay Charlie's fee, right? This is great for the user. Everyone just goes for the lowest possible fee, and everyone just pays the minimum that is required. Now this sounds pretty cool because for the users, once again, it's super advantageous. And on top of that, if you overpay, you get your gas price paid back to you. But you can easily see how this is manipulated, right? If you're a user, you're just going to pay the lowest possible fee. Now, this is a very manipulative, that's a very difficult word, by the way. I try saying it a couple of times in a row. Anyways, it's a very easy market to manipulate. Good job, me. And at the same time, it's a death deal to the miners. I mean, at the end of the day, you need miners to mine the network to make transactions go through. So you want a mechanism that is fair to every participant on the network. It's beneficial to the network, it's positive or a net positive for the miners, and it's a net positive for the community itself. So our main man, Vitalik Buterin, for those of you who don't know, he's the guy who came up with Ethereum. He proposed an alternative solution. Now, his proposal was a base fee. Base fee. I don't know if it's one word or two words, but this is the way he writes it, so I'll stick with it. And basically, a base fee is a very simple mechanic where if the demand on the network is high, the base fee increases. And if the demand on the network is low, the base fee decreases. Quite simple, right? However, this is also where it gets kind of gritty, kind of technical. See, when the network is congested, right? When there's a lot of demand on the network, the blocks where the transactions go are filled 100%, are filled to the brim. So what do miners do? They include the transactions that are most beneficial to them, right? They're the ones that pay the most, so you would include them in the next block. Now, where this improvement protocol comes in is it allows these blocks to be filled to 200%. Now, crucially, you don't want every block filled to 200% because this would just increase the size of the blockchain and make it twice as big effectively. And it also improves or gives more attack vectors to possible people who want to collude the network. So you want this extra 100% to be an option. And the way this is created is by having tiered base fees. Let me be specific. So the fee from 0 to 50% in a block, and this is an example here, is maybe 50 Gwei. Now from 100 or from 50 to 200 is 200 Gwei. And from 100 to 200% is 1,000 Gwei. So you really want this base fee to be a tiering mechanism that you want to use in order to fill these blocks with transactions determined by how desperately or how purposefully people want to put their transaction through on the network. So, short recap. Gas is what you use on Ethereum. It's what you use to make stuff happen on Ethereum. Now, the price for gas, the amount you pay for gas, fluctuates depending on how the demand on the network is. So you pay a higher price when the demand on the network is high, and you pay a lower price when the demand on the network is low. Now, this leads to huge spikes that we saw in over a long period of time, but also in a short period of time. You know, the day to day, and within a couple of days, the price for gas can vary threefold. Now, in order to stop this issue from occurring too much, Vitalik proposed the introduction of a base fee. So what a base fee essentially is, it's a tiering mechanism. So you can picture a block, and as that block fills with transactions, the fuller the block gets, the higher the base fee gets within this block. Now, on top of that, when the block is filled to 100%, what you have is an additional 100%, a kind of reserve tank to every block that you can fill with transactions that really want to be put through, that really want to pay that extra amount to be put through at all times. So as a user, how can you use this base fee to your advantage? Well, for example, let's say you have a transaction or an interaction with a smart contract you want to do, but you're not really in a hurry. Similar to the way that some people, they like to do their laundry in the middle of the night because electricity is cheaper. And you can do the same with a transaction. If you don't mind waiting a little while, you can put the base fee of a transaction low, and you'll just have to wait. Wait till you are able to join a block that is not completely full and that matches the base fee you're willing to pay. The second thing to note is that the base fee is burnt. And what that means is it's destroyed. The fee you pay is destroyed. And the implications of this I'll get onto later. But for now, it's important to note that this stops the miners from purposefully congesting the network. Right? They would have a vested interest in having as many people pay a high enough base fee as possible. So in order to stop this from happening, the base fee is burnt. This, once again, removes the incentive for miners to congest the network. Now, as you can imagine, initially miners weren't very happy with this. The fact that they would not get their fees paid is a huge loss of income for the miners. So in order to be paid, in order to be compensated, the miners now actually get paid through a tipping mechanism. So every transaction or every interaction you do on the Ethereum network has a tip, especially for the miners. This is kind of similar to the way it works at a restaurant, right? And if you're feeling especially generous, you can increase your tip to compensate the miners. Now, on top of that, the base fee cements ETH or Ethereum as the number one, or actually the only currency you can use to pay for gas. So if you're quite smart about it, you can actually use a smart contract, or you can use ERC20 tokens, or you could use stable coins. You could use other mechanics to kind of game the system so that you don't have to pay with ETH, but you can pay with something else to compensate the miners. Now, what this improvement proposal does is it cements Ethereum as the only thing you can use to pay for transactions. And this is very important for the long duration, for the long-term growth of the Ethereum network and the Ether or slash Ethereum token. Now, finally, the last thing the proposal does is it makes, this is probably one of the most important ones to investors, is that it makes Ethereum deflationary. And what does that mean? Well, because gas is burned, right? It doesn't come back into the network. So a tiny amount of every transaction is burned, right? And as you can imagine, as things burn, there's fewer of them, and it actually causes disinflation. And I'm not saying deflation, I'm saying disinflation. And the difference between that is very important because deflation basically means there's less of something over time. And disinflation means it's something that just stems inflation, so it stops inflation. And the reason I call this disinflation is because I think it's about 7% now. The inflation rate on Ethereum every year is about 7%. And transactions are going to put a less pressure on that inflation. So it's going to, instead of going like this, the inflation will go like this. So it's disinflationary. And this is a very important mechanism for investors because to every investor, if you're investing in an asset like this, you want there to be as few of them as possible because fewer equals higher price. So let's put that together real quick. Before you put out a transaction, you determine your own base fee. If you're not in a hurry, you set your base fee lower. If you are in a hurry, you set your base fee higher. Now, the base fee you put for every transaction, when the transaction or interaction on the network goes through, the base fee is burnt. It's gone. Now, this is a disinflationary mechanism, i.e. it presses down on inflation. Now, in order to compensate the miners, they don't get paid that gas because it's burnt. There needs to be a new mechanism, and that's why tips were called into life. Now, these work similar to the way when you tip a waiter at a restaurant. If you're a cool person, you generally do. But these miners now get paid through tips. There's a minimum tip that is in every transaction, but you can add to that if you are feeling generous. Now, the base fee also cements Ether as the only currency to be used to pay for transactions. See, previously, if you're smart, you can kind of game the system and pay through other mechanisms, but the base fee cements Ether as the one and only currency. Now, to underline all this, base fee is great for the price of Ethereum. Now, the aim of this channel is not to only provide information and give news. It is also to help you guys understand how things fit into a grander scheme of things, how to, critically reason with developments. Now, in the case of EIP 1559, it is a form of monetary policy. It is a digital monetary policy. Let me explain that for a second. So you know the way that central banks print money? They do this to speed up the economy. They add money to the system. It causes inflation, which makes debt a little easier to deal with. But at the end of the day, central banks, they put money into the system or take money out of the system. They put money in to speed up the economy. They take money out to cool down the economy. And this is monetary policy. It is a way to steer things in the grander scheme of things. And what the guys of Ethereum have kind of implemented with EIP 1559 is a monetary policy. They have changed the way the inflation rate works. They have changed the issuance of Ethereum. They have changed how much money is being put in and out of the system. And with money, obviously, I mean Ethereum. Now, this change in monetary policy is interesting for a couple of reasons. Now, the first one being that where central banks, when they change their monetary policy, it's generally to the benefit of some people and it doesn't benefit other people. To make it very, very concrete, if they increase the money supply, it increases inflation. And generally, when you hold assets like stocks or gold or something and you're an asset owner, it benefits you. If you're a working class person and you have to pay groceries and do the basic things, then inflation is your worst enemy, unless your wages increase with the same amount of inflation, but it generally doesn't happen, right? And what this monetary policy has done in Ethereum is it has actually aligned all the players. It is beneficial to everyone in the system. Now, on top of that, generally, when you do well in society, you pay more in taxes. So essentially, as you move up the ladder, taxes are increased, so you get pressed down again. So it's a disincentivizing method, right? Now, on Ethereum, on the other hand, the incentivization mechanism is upside down. If you do well, so if you write good code, for example, you are actually paying less in gas. So the cost of doing business is turned upside down, where if you do good, you pay less. This is the polar opposite of what we have in contemporary society, where if you do well, you're supposed to pay more. So I hear you ask, when are we getting this awesome upgrade? Well, it's 99% done apparently, and it's currently running on some test nets, not all of them. And I also had a look at Tim Byko, who is an Ethereum core dev. I had a look at his Twitter, and he said that the proposal, the Ethereum Improvement Proposal 1559, should be ready to be considered for mainnet. And you can check out the checklist on GitHub. I'll put it in the description down below. Here you have it. And you can see that most of the stuff is indeed done. So the way this works is generally when something is finished, when an improvement proposal is finished, it is put through to the other core devs. And once the other core devs, Ethereum's core devs, sign off on it, it is implemented in the next big Ethereum upgrade. Now this next Ethereum upgrade is scheduled for summer of this year, so summer 2021. So from the looks of it, we'll be getting this major upgrade to the Ethereum gas price mechanism by summer 2021. So there we have it, folks, coming to you summer 2021 apparently. EIP 1559, it's a new deflationary auction system. It's an overall disinflationary system. It's a fair auction that benefits users, miners, and the network alike. It gives more predictable fees, it's less congestion, and in the grander scheme of things, the way you can conceptually think about it, it is an example of a monetary policy. So thank you so much for watching. I hope you learned something from this episode. I had a lot of fun doing it. If you like the content, please subscribe. If you have any questions, send me a message or leave a comment down below. I'd love to get back to you and engage with you guys on topics as such. So that's it for now, guys. Have a wonderful day. Thank you very much. Bye.